Here to talk about today is Social Security, and hopefully you'll get better advice than they give on how to maximize your Social Security. This has got a lot to it. It's going to probably take up most of our time, depending on how many questions you have at the end. And I would ask that you do keep the questions to the end. And if I forget to do this, because we're recording this, I need to repeat your question because we're not going to run microphones around the room. So Lynn will remind me, and anybody else wants to remind me, repeat the question. But if you would, hold it to the end, because I think some of the questions will get answered along the way. So the disclosure is I don't work for the Social Security Administration. I think y'all knew that. Here's something that is of interest to you. One of the things to keep in mind is that the return of other assets over the last several years has been dropping, the safe ones. So Social Security is one of the very safest investments, if you want to look at it that way. I think a lot of us, when we were paying in the Social Security system in our 20s and 30s, the people here in the room thought they'd never be able to collect. And they did change the rules a little bit to make sure it gets funded. Like, not everybody can now draw full benefit at age 65. But the rates have dropped again as of, when the Treasury just dropped it. So the safe investments, the fixed rate on those is dropping, but the Social Security system has actually kept pace somewhat using cost of living adjustment. This is showing you some information on the funding of it. And of course, some of that's, it's easier for me to see the one in my hand. Some of that is information in the future, so it's projected. But right now, it's able to pay the benefits that are out there. And we still have the ability, they're predicting until next year, that payments will be made from interest earnings. So there probably is something that's going to need to change. But one of the things to keep in mind when we're looking at Social Security benefits is once someone's near retirement age or already drawing, there's not been changes affecting those people significantly. They have made it to where more of it's taxable, but that's been like since 1993, the last time there was a change regarding that. So that's one of the things you can look forward to. It looks like we did make it, most of us in this room, I'm looking around people of similar age as me, that it does look like we're going to be able to draw the benefit, which is really good news. On the next one, we're going to talk about things you may anticipate that could change to make sure it's funded fully. One is they could change that earnings cap. It's $132,900. So, some thoughts are they could make it unlimited. I don't know if you recall that Medicare used to have a limit on its wage base. Now it's unlimited. And Medicare has actually been under more funding pressure than the Social Security system has been, and that's the reason that was necessary. So, but once you're drawing, the situation should be locked in, or historically, it's been a very high priority in the United States government to keep that in place. Another possibility is moving it. Right now it's gradually increased to 67. They could move that further. So that's a possibility for probably not many people in this room or that are close to drawing age, but for younger people. Currently, to fully fund it, if they didn't change those items, then we need an increase in the payroll tax rate. And the 12.4, that's the amount withheld and matched by the employer. So we need about a 3% increase to keep it fully funded. But again, none of those changes would impact the benefits. There is one that may change, and that's the way they calculate the consumer price index. So if you look at that higher number, that's the one they're currently using, CPI-U. There's one called chain CPI, which they believe may be a better indicator of household costs that could impact Social Security, but that would only be those cost of living adjustments that they do annually, or hopefully annually, once you're drawing benefits. That's how that would impact it. And so the increases would be less. So that's one way they may address the funding issue. And we're going to be going through all this just to let you know the end game of what this presentation is about, to show you an overview of things that are going on in the Social Security world, but at the same time, how it directly impacts you and what you can do to up your benefits. And that's what your goal, I mean, keep in mind, when we get to that point, that's really the point of this whole presentation, is to be able to maximize your benefit, and if you're married, for you and your spouse. So here are some of the options. Claim early or claim late. Now, a lot of people may not realize this, but this is that PIA is the primary insurance amount, and what you're looking at is the percentage of your full retirement benefit that is available to you by drawing early or deferring and drawing late. So if you don't draw, I mean, I think most people think it's a decision between full retirement or 62, but it's really not. You can also wait till age 70, and you can get a much higher percent, 132%. So you wonder, well, why would you not wait till then? Well, the two main reasons are life expectancy. If there's life expectancy for you is short in your family history, or you're experiencing some situation, that's one reason. The other reason is cash flow. If you can't afford to wait, you need the benefit now, even though that's not the best long-run approach. But we'll take a look at how to analyze which direction to go with that as we keep going. So these are actually some statistics on how Social Security is currently being handled in the United States, or how much income it represents of different people. It's 90% or more. I know you can read this, but this is kind of staggering to me. And this is actually, I've got two presentations available to me, and I've meshed those two and added some other things to it. But this came from the American Institute of CPA's presentation I sat in on a few weeks ago. 90% or more income for 20% of married elderly people, and 41% of all unmarried elderly. So for 41% of the single population in the United States, their Social Security benefit represents 90% of their income. That's pretty staggering. I mean, that's a lot of people that live just primarily on Social Security. It's more than half of the income of 52% of married people, 72% of unmarried, and it's 40% of income for all elderly people. So the poverty rate in 1960 was 35%, and in 2018 it's 9% of 65 and older. But if there wasn't Social Security, the poverty rate would be 45%. That's, I mean, that's just, it's hard to relate to. And trying to relate to 1960, you don't hear about that. I mean, the poverty rate was 35% in 1960. That's just really difficult to grasp that our country was in that situation. You think we have problems now, and that's one of the reasons you think, well, how can they not keep funding Social Security? There's over 63 million people receiving benefits in 2018, $941 billion. 75%, most of what we're talking about today is some form of retirement Social Security. That's the emphasis of this presentation. There are other types, disability being a big one. That's not, we're not going to be discussing that. That's a whole nother topic. As a matter of fact, the whole Social Security system is extremely complicated. This book comes out annually, and it's called a Quick Finder on Social Security. So this is the condensed version of things you can look up. And we use a service because it's pretty much impossible for a local CPA firm to have that depth of knowledge in Social Security. We subscribe to a service that we can call people and run different scenarios by them. This presentation, part of it came from them, and the software we use is developed by them, which I'll show you some example of in a few minutes of how to maximize the benefits. But it's a complex area. But we're going to simply strictly stay on the retirement side of things, which actually includes three components we'll get to in a minute. And remember, too, when we're looking at these numbers, the baby boomers still have 12 years to go before we're fully kicked in, and that's where big numbers are. This kind of reiterates some of the other information, but it does give you the monthly maximum Social Security benefit. And the cost of living currently for 19 is 2.8%. So here's where we get into strategies that we wanted to talk about, is how you can develop a strategy to maximize your benefits. So we're going to walk through this comparison, but this is an example of a couple born 1949, 1953. He was the higher wage earner. It makes some assumptions about how long they would live. And so his assumption is he lives to 85 and she lives to 90. So if they were to file at age 62, now when you look at these numbers, this is as if you were to buy an investment that would pay out your Social Security benefit. This is comparable to what that cost is that's on the screen, that number. So if you wanted to buy your Social Security benefits for this particular couple in this example, at age 62, they would have had to pay $860,000 to be able to generate that benefit, that payout to the day they died. But if they use the recommended strategy, that same current dollar value is $1,066,000. So there's big dollars at stake depending on how you file for your Social Security. And it's not a simple analysis. It's not like, I can't say, I can give you some generalities of what typically we see as being the best way to structure them, but it doesn't get down to the exact strategy that's necessary. So I wanted to walk you through that, what we're looking at there. And I need to catch my own notes up over here. The next part that we're going to take a look at, this is just kind of giving you this married couple, what I already told you. But these are the main components of the retirement benefits. And we tend to focus just on the retirement payout period. But you've got to remember there's more to it than that. There's also a spousal benefit and there's a survivor benefit. So one of the things you need to be cognizant of is that if the higher wage earner has a shorter life expectancy and draws early, and maybe it's typically the men don't live as long. I think it's 14-year spread. Women outlive men. Draw on Social Security 14 years longer than men do. If you try to maximize or draw early for him, you may be costing the spouse 14 years worth of a lower benefit. So that's one of the reasons it's very important to look at the two people combined. And then that's the survivor benefit. The spousal is the ability to draw against your spouses and allow yours to be parked and build up to that age 70, that 132%, while the other party is simply drawing theirs and you're getting what's called a spousal benefit. Yours is sort of parked and building in value. That's a strategy. So there's a lot of options there, but these are the three components of benefits that we're looking at. Notice we don't have the disability one in there because that is not the focus of what we're covering today. And here they're kind of talking about the survivor generally receives the higher of his or her own benefit or the benefit of the deceased. Now, that's what I was referring to earlier. If the wife was much lower earner, was a stay-at-home mom, that type of thing, I know I'm being sexist. Flip it the other way if you want. I mean, I can't be politically correct on everything, but that there's some scenario where one's much less than the other. Keep in mind that the highest benefit for that other person may be the half of the other person's full benefit. And that other person's benefit is locked down based on when they apply for the benefits. So I said benefit about 20 times in there. But that's a very key issue that you need to look at and to calculate the possibilities in each person's scenario. The software actually does a whole lot of iterations and then comes to which one maximizes the current day value of it and gives you very specific instructions. We'll look at that in a minute of how that works. The There's that 14-year number. 80% of women survive their husbands on average 14 years. So that's a long time to have your benefits reduced if you make that mistake. And it's not impossible to undo a decision like that, but most of the time it's impossible to undo it completely. If somebody starts drawing early, we'll take a look at that. There are ways that even if you've drawn early, you can change your strategy to maximize for a longer term benefit if it makes sense in that situation. And 98% of widow benefit recipients are women. So when you say widow, that means the surviving spouse. 98%. I don't know what's wrong with men. why we die so young, but it just seems to happen. Okay, so here are some of the strategies. And the company we partner with has actually registered this as a trademark, switch strategies. You get more to get you more money. Claim your own, then add a spousal benefit. Claim your spousal, then switch to your own. Now, I'm going to cover a little bit of information that I don't think is going to apply to anyone in here, because there was a window of opportunity a few years ago. I believe it was 2015, the law changed. There used to be an option, and you may hear about this some, just in case you do, you know what was going on. There was an option to where, say, the higher earning person could go in, apply for their benefit, and then file for it to be suspended immediately. And what that did was they aren't drawing any money. Their benefit continues to build to age 70, but it allowed the spouse to draw the spousal benefit during those 5 years. That was like free money. And they did away with that a few years ago. Actually, we were doing this service at that time. We hadn't been in it real long, and we had several clients that were able to get into that right before it shut down. And you had a deadline by which you had to make that decision to apply for it. But it was based upon when you were born. So most people that have not drawn yet wouldn't qualify for that. But you may hear about that or read about that in some of the information that goes on. And there's one other thing I wanted to touch on when we're doing this analysis. And you saw those poverty rates and how much money's retirement is funded. If somebody is in a situation to where they don't have outside retirement income or not sufficient to live on, and they're at age 62 and they aren't employed, then none of these strategies are going to work for them, because they need the cash. I mean, and so there's some people, I've had people say, well, how can we do more? And I talked to them for a few minutes, and I said, well, you don't really need to hire us to look at that, because if you can't defer several years before you start drawing the full amount that's available to you today, then don't pay us we don't do it for free. Don't pay us for running the analysis, because there's no point. So that's one of the situations that where it just doesn't even make sense to even look at this, because then you just get upset that you can't wait. Because there could be benefits down the road. But cash flow is obviously a need of a lot of people. Divorced individuals. Now, a lot of what I'm going to talk about is married couples, but divorced individuals have some of these same options. One of the first three, I think she was like the second one, I know it was one of the first three of these I ever did for someone, was someone that was already drawing Social Security. And we were actually experimenting with the service to see what it could do for us. So we went through the process with her and ran the numbers. And what I was coming up with was like, you should be getting a whole lot more Social Security money than you are. And I called the back office of the consulting people and asked them, what do you think's going on here? Well, it turned out she'd been married for over 10 years, never remarried. The Social Security office, she'd never been asked the right question about those things. She was able to draw on her ex-husband's higher benefit, and they did not pay her for that. So after we ran it, she took it to them, and they looked at it. She ended up with thousands of dollars in back Social Security that she was able to collect. So she was real happy we'd looked at hers. That worked out very well. But there's a lot of complications to that, and things happen that just get missed sometimes. Survivors have options. So if you're a widower, you can claim the widow and then retirement. So and let yours build. Or there may be a situation where you want to do the opposite. So there's lots of different things you can do to switch. Now this is the voluntary suspension that I was referring to earlier. That was in 2015. So actually, if you fall in that window, it's going to get a little more complicated. It has to do with birth dates, but I think most of those options have now gone by the wayside. Let me just check one thing. Yeah, that very much reduced the possibilities of what you can do. And here are the dates of phase out on the next page. So you had to have been born on or before January 1st, 1954 to be able to do an application for spousal benefits and delay the receipt of the retirement benefit. See, that's the one that's the big one that everybody was taking advantage of, and now that one is gone based on those birth dates. And so you had to have done that by April 30th of 2016. So now here's an example that we're going to walk through of a couple of what John and Jane should do on their strategy. It's similar to that other, was just a highlight of what's available, but we'll talk through all the things that are available when you're doing this analysis. So typically in our basic service is that we will run a scenario of what if you drew now, and what's the optimum situation that we could come up with. And these results are fairly typical. You've got a pretty big difference there in those two possibilities. So, and when it says 81,500, remember what that represents is the difference in what you'd have to pay right now to purchase that benefit at a market rate of return. So that's real money in your pocket. It's very significant and something you don't want to take lightly on how to do it. So in this instance, and this is generally the way these things will roll out, is file a restricted application only for your spousal benefit on Jane's earnings. So what's happening here is we're going to let John benefit. We're going to park it. So he's not going to draw on his own till he's age 70. So it builds up to that higher number that we looked at in the chart. What was it, 132, 34? I don't remember now. The higher number. So his is building, but he's able to draw against his wife's because she begins drawing at a younger age. So really what's happening first is Jane files a standard application at age 63 years and 11 months. And so based upon the earnings and the information that's been put into this system, then approximate benefit would be 1104. And then he's going to get to draw half of that, if you go back up to the top, as a spousal benefit. So remember it said half of the other person's would be the spousal benefit, but it's leaving his alone so that when he turns 70, he can go and draw on his own benefit. And so all this time he's drawing on hers and leaving his to build. And that's the strategy where you can make a lot more bang for your buck out of your Social Security benefit, is by doing that approach. Now, there are a lot of questions that get asked because, you know, if you knew the day you're going to die, you probably wouldn't want to know the day you're going to die. But if you were to know, you could get this much more exact. So unless somebody tells me, I always ask, you know, what do you want me to use for your life expectancy? It's always such a pleasant question that most people say, well, just use the national average. In the software, some of the stuff we're going to show you about averages and averages returns, the software keeps that updated all the time. So it uses, you know, the demographics of the country. But if you know there's a history in your family of something and you want to cut it by a few years, or you're gonna your parents have lived into their late 90s, early 100s, you want to use something longer, all that can be factored in. But none of that's going to be an exact answer. So the other thing that always comes up is that people want to know, well, what happens if we die at a different age? So part of what this analysis does, it's going to show you when the suggested strategy is better than the draw early strategy. So if you've got the wife's date of death along the left side at her, her age, and then the husband's across the bottom. So in the orangey red section, that's showing you, well, you should have drawn early because you didn't live long enough for it to work out better for you the other way. But it also gives you some good ideas on, what combinations are going to make that other strategy work. So if it turns out that, it's not that big a difference, and, it's a big risk if based on this chart, then you can make a better informed decision about when you want to draw. I mean, you don't, obviously, you use whatever strategy you want, draw on whatever date you want within the the Social Security rules. But this gives you some additional information on it. Now, the other thing that we can give you in process of doing this is that if you have an amount of money that you need to live on annually, then you can look at this too. So this is the blue graph there is showing you the Social Security income. And the line above it is showing you this is somebody that said they needed $60,000 a year to live on, and it's going up because of inflation. So there's a gap there that you're going to have other funds with to fill that gap. Then it drops lower because what that represents is when the first spouse dies. And so in this scenario, most people I dealt with have said, well, it's really not going to change our cost of living much if one of us passes away. It's going to be about the same. So that line could just be one line, but the benefits are going to drop off when the one person passes away. So that's like the gap in income that you're going to need from other sources to be able to get there. So the big difference between this one and what you're going to see in the next one is when it starts. So if you look, maybe it's better to show over here. When this gap starts here. See, that gap's pretty big. Here it's huge because that's got to be from some other source other than maybe you're still working. But when you go to a delayed strategy, those early years, and I'll show you that right now, those early years are going to be bigger gaps because this is the spousal type strategy. So then this gap becomes much less, but in the early years, you've got to have cash flow to go with that strategy. And one of the things you also need to be comfortable with is, let's say that's built up through individual retirement accounts, that money, you're burning through your own money faster. So you got to be comfortable with that. Some people are not comfortable with burning through their own money faster. But just let me take it back to the previous one just so it's very clear. See, the early years here, there's not a big deficit compared to the one here. But then once you get past that, you're much closer to having Social Security fill all your needs of income. So it's not just a long-term decision, but it's also a shorter-term cash flow decision that you kind of have to look at. And your comfort level of using up your own assets ahead of using Social Security. And one of the things I have seen happen is that people that want to leave a lot of money to their children don't like that burning through their own assets early because they think, well, what if I pass away sooner? Then I'm not leaving my children as much because they're not going to get the Social Security that you didn't get. There's a lot of things to consider. So why not just ask Social Security Administration for advice? Well, one of the main reasons is their job is to get you the largest benefit on the day you're in there filing. They're not looking at a long range, what if you were to defer and let it build up? Their job is to get you the most money they can get you the day you're in there filing. And that won't consider the spousal benefit issue or any of those types of things. The other one is they can't give advice. They can only, process the information that you provide them and ask questions. So, and they can't coordinate benefits with outside assets. So, that's one thing that this fills a piece of. But I think one of the things that everybody needs to realize is that you also need to be working on your financial plan and how that coordinates in filling that gap we were looking at a little bit earlier. So, and that gets back to those dollar gaps. Some of you may have retirement plans through your employer. It seems like anymore, there's very few what's traditionally been called pensions anymore, where they're guaranteed amounts you're going to get from an employer. Most of the time now it's, money put into an account, and then you can determine yourself how to invest it, self-directed. When you leave employment, a lot of times you have the opportunity to roll it into an IRA and invest it yourself. But again, you got to fill those gaps. So really, the Social Security payments are more like a traditional pension, to where you would work and then the company took care of you. Well, the government sort of taking care of you through the Social Security system. They'll take care of you one way or the other, right? Which brings us to the next part, which is about how you get taxed on this stuff. So there's a calculation you go through on how Social Security is taxed. And I really don't want to spend a lot of time on this part, because one of the things I've always told my clients, about how do they cut, they always want to know how they can cut tax, and they'll have a big profit and not be happy about the tax, which I guess nobody is. But one thing to always keep in mind, it's always better to make money and pay tax than not to make money. So we're here to make sure you get the most out of your Social Security benefits you can. And then secondary thing to look at is the tax of it. So, and I have this conversation with a lot of small business people, and they said, I'll get questions like, well, should I buy a piece of equipment? Well, the first question is, do you need a piece of equipment? Because if you don't need it, the tax deduction is only going to get you, maybe at best 40% of the cost covered through tax savings. So keep that in mind. But taxes are a part of this. So there's, they can be taxed at 0, and they can be taxed at 50%. They can be taxed at 85%. So I really don't want to spend a lot of time on this, but that's the basic rules. Now, my suggestion would be you want to maximize that Social Security benefit. Taxing it, it's actually an annual event to figure out how that's going to work. I'll give you some examples. I've got some clients that have IRA money and they have Social Security. They don't take, they did well when they were working. Their Social Security benefits are pretty high. They don't need a lot to live on. They don't want to take much out of their IRA, but I've seen them, well, what happened last year? You took $30,000 out of your IRA. Well, I had a grandson that needed to buy a car, or I needed a new car. Well, suddenly that $30,000 is not just creating tax on $30,000, but now some of the Social Security becomes taxable. So I work with people to try to smooth that out and try to get them to take a little bit out of the IRA each year, and a lot of times they get it out tax-free, or look at their tax brackets, keep it in a low tax bracket. But it's good to have other options. It's good to have things that are tax-free that you can tap into, which could be savings you already paid tax on. It could be a Roth IRA, something like that. So it's good to have in your mix of things you can draw on, tax-free income, taxable income, and then Social Security, which is partially taxable. But rather than get into the mechanics of how this works, just keep in mind, depending on your income, it can be, there's the threshold, 50% taxable at that level. This is a one person. Here it is for married. So a lot of people get hit at 85%. So some people just aren't going to get below that. Others are. That's one thing you may keep in mind, is it may have a little impact on when you decide to draw, but I think it's very minor compared to the timing of, drawing a spousal benefit, all the things we've been talking about previously. So these are examples. You can look through them. Basically, to me, this kind of exaggerates the whole situation, the way this is laid out, but it's showing you that the total taxable benefit in one scenario is $4,000, and the taxable benefit in the second one is $11,100. It jumps a lot. That doesn't mean the tax jumped that much, though. So I prefer to run a tax scenario, and that's not really what this presentation does, but it does illustrate that Social Security is taxable. And when they, 1993 is when it went from 50% to 85%. I remember that well. I'm thinking, that's really rotten because we're already paying tax on that money. I mean, at least the half that was taken out of your paycheck, it's part of your taxable income. And now we get to pay tax on it again. To me, paying it 50% made a little more sense. The employer paid that in for you. But this is what we have. And this is part of how they kept it funded long ago. But I did mention earlier that there are some options on people that have already started drawing if they want to change what they're doing. And let me look at my notes because it gets a little more detail. There used to be, until 2010, what's called an interest-free loan. You could actually draw early, decide to repay it all, and then it never counted as if you had drawn early at all. And they didn't charge you any interest on that. Kind of interesting idea. But now that's only available for the first year. I want to get this right. 12 months from the date of initial election. Now, there is another option in there. I'm trying to find the dates. There is a time period in which you can repay. I think it must be covered a little bit later, but I believe it's once you hit full retirement age, if you've drawn early, you can then suspend that and let it build up to age 70 again. So if you drew early, decided, I shouldn't have done that, if it's in the first year, you can fill this form out, pay them back, go back to as if it never happened. But there's also a period, and I believe it's from full retirement age, which could be 67, to age 70. Within there, once you hit full retirement age, that you can stop what you have. Then it goes back to building value higher until age 70, and you pick back up. It won't get you where you would have been if you'd never done it, never drawn at 62 or whenever you did it. But it may be something that you change your mind about, and you may be something to look into. Actually, we can run a scenario of that, but it gets a lot more complex than the basic scenario that I'm going to show you here in a minute. And this just kind of talks about the different options and why it's important to use an advisor. The age gap between spouses may affect how yours is. It's not just something you can say in general. If I were to say something just basically in general, typically the higher earning spouse wants to definitely wait till age 70, and the lesser earning one would draw early, and that higher earning one would draw the spousal benefit on them. The exact scenario they were showing in the example, that's typical. But the exact timing of that varies. I ran my own, and I was really surprised because I thought I knew what it was going to do, and it didn't. But that can change a lot with longevity. It can change a lot with, the mix between who earned more and the age gaps. So you can't really give a really good answer without running an analysis on it. So this is one that I've just dropped in here that we prepared on the software. And it looks, Lynn's kind of fancied it up, but it's going to look similar to this because this is actually a report on a example client. So this is what you would get if we were to run this analysis. You get that cover page. Now here it's going to give you the assumptions, and it's mainly there to make sure we got it right. So in this one, born in 1950, she was born in 1953. We're assuming an inflation rate of 2.8%. I don't know why it's got a 0% rate of return. Full retirement age is 66, and that's their income need is $8,000, and then after one passes, $6,000. So, and then there's estimated monthly benefits, and we calculate those typically. We don't try to use the you can get from the Social Security Administration, you get that earnings record, and it tells you what your estimated benefit is. We prefer to use the actual earnings record, put it in the software to get a more accurate answer. We can use the other one, but I've not done it yet because if I can get that one number, I've got the whole earning record, and it's much more accurate to do it that way. And so in this scenario, it's about a $70,000 difference between the earliest and the optimal. So this is break-even chart is actually more realistic of what I've seen. They're not usually just that square thing. So this makes it a little more difficult sometimes, or a little more insightful on what you want to do if you don't decide to just take the suggested rate. So you see, it's not real simple in the way it helps you make that decision. But if in this situation that if he died at 75 and she died at 80, you'd been better off taking the earlier one. So that's how life expectancy is going to play into the decision you make. And this is the page. I mean, typically people want to use the suggested strategy. So what I do when I get this report is I flag this page and I tell them, I said, when you go to this, go figure out the exact date that these events occur. For instance, in this place, when she turned 66 years and 7 months, I'd back it up a couple of months, set an appointment with the Social Security Administration, and take this with you so it doesn't get confusing when you're in there. And this is what I want to do. Just show them that piece of paper and say, this is what I want to do. And that's been the way that worked the best. If you decide, it's something that strategy is what you want to do. Then this is back to a little more detail on those graphs of what it is you're looking for cash-wise to fill the gap. So this puts it in dollars, real dollars, and by year of how much money you need to come up with to bridge that gap. And this, again, is the suggested strategy. So you see in those early years, the gap's pretty large. And then when the Social Security kicks in, it gets much better. Now, here's the earliest strategy. Same information, but now you're just drawing right away. And you see the gaps are not as much early, but they continue, and the present value of that is quite a bit, is the $80,000. And here's a whole lot of just sort of boilerplate information that will be in the report. Talks to you about, the retirement, the earnings test, if you're still working, how that affects you. And now this is the earnings record that was used to come up with this information. Somehow it looks like it dropped his. Oh, I think maybe on his they just used the estimate, but I typically fill all these out for the earnings record and then some disclosure. So one of the things too that I wanted to talk to you about is what does it take? What information goes into being able to figure this out? And you should have a married couple, two-sided document here that doesn't have all this yellow on it because these are my notes. Basically, the only information you need is the name of each of you, that first line here. Now, I don't run into this very often, but civil service pension can impact Social Security. So that information's in there. It asks for current gross benefit amount. I don't usually use that. I want the earnings history, but this would be if you are already drawing. So if you're already drawing and you want to consider the other options, I really don't have many people. Usually once people start drawing, they don't want to switch what they're doing. So I hadn't had many people that we went and reworked it to see if they should pay back or suspend when they hit full retirement age, that type of thing. But we can do that. The earnings history down here under A is going to give you where you can download your earnings history from the Social Security Administration. For some reason, that website address there, it works, but it just kicks you over to ssa.gov now rather than that full typed out thing. But there under B, I don't usually use that. Now you can do a lot of things down here under assumptions, but the inflation rate it says suggested of 2.8. It keeps that current, and the real long-term rate of return 0.79. All that information, people rarely give me numbers there because the software will fill that in with the current estimations. But the projected future income is important because what that's telling me is how many more years you're going to work and at what level. The reason there's two lines, this is just the client, and the other says spouse. You can use husband and wife if you want. But if you're going to change, let's say you're going to work 5 years for $60,000, and then you're going to cut back for 3 years at $30,000, and you could keep going. I mean, there could be any number, but these are into the future. You're estimating how long you expect to work, because that comes in, your future earnings for Social Security purposes are going to count in how your benefits calculated. So that's what this is about. Then on the back page, you're basically getting the same information, but on the spouse. And one other thing, I thought that was on here, but I'm looking for it somewhere. It asks for, the very last thing on the back page, your pre-tax monthly household income upon retirement. So what does it take for you to live on? And that's how those gaps are calculated that we were looking at a moment ago. Like, it's easier to see, but the lines there that are showing you, that's based on that number. That's on the back page, the next to the last line, and the very last line is, would it be different if one of you passed away? Would it drop typically? So I guess there could be situations where one passed away and they were the ones that never spent anything, and suddenly somebody's spending a lot. Who knows? You never know. You get in all kinds of weird situations. So that's the service that we offer, and I think it's one of the most cost-effective services. And you may wonder, well, why does he think that? Well, I'll tell you how much it costs and how it works. People often want to get that cost out of the way. It costs $400 flat fee to do the suggested and the early. And what we do for that fee is we don't meet with you initially because we don't have anything to talk about yet. So what I like to do is, if you're interested, you can look at this over and fill this out. Now, the same type of thing will work for a single person, but I'll tell you from experience, the situation becomes a lot more straightforward. A lot of times it's just the cash flow longevity question because there's not a spousal benefit, there's not a widow benefit. But we gather, in either scenario, we gather this intake form completed, and then we need the earnings records. And they need to be up to date. So if you've got one from a couple of years ago, then we're going to need to get the years we don't have, or you can estimate them. And then we generate the report, and if you want one, some people now just want everything by email. We can send you the report to review, and then have you come in and meet with us to review how it turned out and what your options look like. Also, we can just, when you come in, start going through it. I think it's more effective when we send it out to you ahead of time, and you can look it over and come up with questions, because I found that when we meet and we hand you a bound report that you've never seen before and we walk you through it, after we've done that, 2 or 3 weeks later, all these questions come up, where if we can show you that initially, it's a lot more productive meeting for you guys. But then I've had some people that just wanted to cover it by telephone. So, but I do think it's been a well-received service, and there's just not much out there about this topic that I've found, that a service being offered down, but it's so cost-effective in what it comes up with. And let's see, we're getting near the end. Questions? Now I told you at the end. Yes, sir.
How is the higher earner calculated? Is it the total amount throughout all the time you've had Social Security, or when there's a married couple, or is it so many years and years you've been married? How do you determine who is the higher earner?
Okay, I'm remembering. I've got to repeat that question. But the question is, how do they determine who the higher earner is for Social Security purposes? there's a minimum amount. It was actually earlier in the presentation, and I kind of blew through it of what quarters can count. And how long you've been married doesn't have anything to do with it. It's, you're married or you're not at that point. But it's pretty much who made more money that was subject to Social Security total. But it's the reason we get all those individual numbers is to be able to calculate it, because it's not always that simple. I, to be quite frank, rely on the software and the Social Security Administration's estimate, because almost always the number we come up with is slightly different than what the Social Security Administration is showing. But a lot of that has to do with, we'll have your estimate of future earnings. We'll have a little bit more information, or if they're giving it to you, like I said, they're there to maximize it the day you get it. So that statement that comes out is today. And if you're going to wait till 2 years from now, that number is going to be different. Even if you don't earn anything more, there's at least the cost of living adjustment that's going to be factored in. But typically you're earning, by waiting, it's building. But so it's usually just who has the most W-2 income throughout their life, but it's a little more complicated than that. So, or self-employed. If you're a self-employed person, that replaces the Social Security system. Other questions? I tell you what, earning credits. Let's see. It says it takes 40 credits to be insured. I think a credit, 4 credits a year can be earned. So you have to have at least 10 years there. But I'm looking for the 35. Okay. Somebody with a phone can Google that faster than I can find it in here. Okay, it's in that slide. All right.
We have a question from our webinar. It says, how long do you have to be married to claim on your ex-spouse's benefit?
Okay, so the question is, how long do you have to be married to claim on your ex-spouse's? It's 10 years, and you can't have remarried. And this is kind of interesting, because they know odds are those people aren't in communication with each other. The ex-spouse never knows you drew on them, and it has no effect on their benefit at all. There's no communication there, which is kind of has to be that way, I guess. But other questions? Yes, sir.
My father passed away, so they both were drawing Social Security.
Mm-hmm.
Now she's drawing his, but had a reduced amount.
Right.
Is that?
It should be half of the higher earning. So the widow benefit was more than her own, is what I'm presuming. Yes. Yeah. You get the higher. The question was that you had one beneficiary whose spouse passed away, and then the surviving spouse was able to draw half of the one that passed away's benefit because it was higher than their benefit on their own. So that's the widow benefit, or I guess it should be widow/widower. But the surviving spouse's benefit can, and that's why typically women outlive men. That's why and if he's the higher earner, that's why it's so important to look hard at what he's doing, because it's going to affect not only his income while he's living, but hers after he's gone. It's a significant decision. Other questions? Wow, it's exactly one. Oh, we got a question. Sure.
Is there a certain age that the widow has to be drawn benefit?
Yes, they would have to. Is there a certain age? Ben, Google that one. The question is there a certain age at which the widower would have to be able to draw the benefit? 60 is? Okay. All right. Yep. Other questions? Sir? Yes. No. Right. Now, usually the question was, does civil service retirement apply to the military? There's less and less of those type of situations that I see, but almost for a long time, a lot of the civilians that worked at Fort Campbell for the government were not under the Social Security Administration. They were under a separate pension system that is the civil service, and that's where we usually see it, or retirees from government jobs other than the military, but they were involved with Fort Campbell. I see that a lot here. Other questions? Well, if you do have ones that you don't want to say in front of anybody, then I'll hang around here. But I got you out on time, which is quite a feat. Thank you guys for coming.